I just got to be honest with you guys. I really enjoy going down this rabbit hole with you guys because this is a much more in-depth conversation than, say, we were having 4 years ago. Right, Brad?
Yep.
All right. That was a good way to start the call. Peter, my man, are you ready?
I'm ready.
All right, gang. Here is what we have for prepared content today. I am titling this month's call, The BRRRR Hack, The Introvert's Edge, and Private Money. I am very confident that in the next 60 to 75 minutes, you guys will be very excited about the path you're already on, using private money, finding deals, finding BRRRRs. So I am very excited about this call. So Peter, I'm going to kind of slide it up the way I believe we would do this, and then you kind of just come on in with your expertise. Sound good?
Cool. Yep.
But gang, this is also the power of a mastermind. Peter and Emily have been noodling on how to get people's money back to them faster on these creative deals, on these BRRRRs, and they have come up with something very slick. When Peter called me about this and told me about it, I was just like, that's awesome. Like, that's genius. How do we do more of this? So, hey, Armand, remember when I said I was going to steal your Facebook post?
Yep.
Here we go. So this was BRRRRs the old way. Like, you'd sign up for a BRRRR and you'd be super excited. And you'd be like, Jimmy, how many BRRRRs can I do a year? And I'd be like, it probably one. And then everybody was like, Judge Judy. Like, that takes way too long. That's not that exciting. Who cares? But now, thanks to Peter and Emily, this is the way it works. You buy the house. Average rehab time for us is 61 days. So, Peter, does it really have to pass occupancy? The bank doesn't even know what that means. Or does the scope just need to be done? Doesn't it need to be appraisal ready?
We need an occupancy certificate so that we can get an appraisal. Does not need to be occupied.
Okay.
Occupancy certificate.
All right. So average rehab time is 61. So let's call it day 80. You call Peter and you start your refi process. How long is the refi process generally?
30 days.
Okay. So now we're around day 100, right?
Yep.
Call it day 115. Then you call Uncle Jimmy back and say, hey, I'm ready for another BRRRR. And we do it again. And then maybe Peter's in Hawaii with the Dolphins again. So then you call Emily and you do. And so you're probably at day 180, 190 at this point, right?
Yeah, basically every 100 days you'd be buying a property. You could get 3 or 4 in a year.
So, I want to temper expectations. I think the proper expectation would be 3.
All right, it's 10. Let's get 10 in a year.
Don't remind me of the 10 and 10. Our first offer to the market was 10 houses in a year for 10 grand. And like, everybody's still exhausted about that. So let's set expectations for 3. So then Peter's swimming with the Dolphins. Emily's knocking out your refi. And then boom, it's the new year and you do it again.
Awesome.
So Peter, this took me a while to understand. Can you explain the 2 type of refis?
Yeah, absolutely. So let me just take a quarter step backwards here, Jimmy, and just say aloha. I just got back from Hawaii last night. I've been in Hawaii for over a couple weeks. So that's my win here. I've been actually out there. I went to Big Island, looked at real estate, looked all over Kauai. I'm excited about a few deals that I'm pursuing right now. Just stay tuned on that. So that's one of my wins. When we look at buying a property, there's really 2 ways to buy a property. It's other people's money. That includes banks, private money, hard money. It includes, family, whatever it might be. And then there's cash. We have our own money and we put the cash in the deal. When we refinance, there's 2 types of refinances, Jimmy says here. There's basically the same. There's a cash out refinance. A cash out refinance means that I'm putting money in my pocket. I own the property. And I am going to refinance the terms of the loan, or if it's free and clear, then I am going to pull cash out and put it in my pocket. And then there's what we in the industry call a rate and term refinance. That's a normal refinance where you maybe have a loan on other people's money on that property, and you are seeking to pay that off to improve the rate or the term or the terms of the loan. So there's those 2 types of refinances. A cash out puts money in your pocket. A rate and term does not put money in your pocket. It's simply satisfying an existing claim on the property, another loan or note on the property, a deed of trust. So
that you said 2 important things. The cash out refi, bankers generally look at that as higher risk because they think you're going to pull cash out and go to Vegas, that you're not a responsible cash flow tactics member, who's just going to pile it back into another investment or keep it in reserve, right?
And even then, even buying another investment, they view as a potential higher risk. That's exactly right. Cash out is considered higher risk. And so lenders lend based on risk. So if the risk is increased, the interest rate is increased, the costs increase. The scrutiny can increase. And so when we do a cash out refinance, you're going to run into some difficulties. The interest rate's higher, the closing costs are likely higher, and there might be a little more scrutiny on the deal. Versus a rate and term refinance, you already have proven that you can get financing. The lenders know that you've checked all the boxes. And so now they're just simply saying, hey, instead of potentially pulling money out and going and doing something wild with it, you're just satisfying another loan and you're doing it for your benefit. You're dropping your monthly payment, you're improving the terms, you're lengthening out the length of time that you have to pay back that loan. And so you're improving your circumstances. So they view that as lower risk. You get a better interest rate. Some of the terms of the loan are not as stringent. You're going to get lower fees, etc. So that's exactly right.
Yeah, so this is another example of why it's a hack. It's a banker's hack. Like, we all think that, hey, being wealthy and being employed or not being employed, kind of my story of once I quit my job and knew what I was doing was real estate, I couldn't get any lending. But now a banker saw it as less risk if I had a W-2. Now, I look at this as the same thing. If you're doing the responsible right thing, bringing your own cash to the table, and then you want it back, they look at it as higher risk. But if you're going to a hard money lender or say a loan shark, they look at that as lower risk and they're happy to pay off that lien for you.
Right. Because you're improving the terms of the loan that you've already got in place versus pulling cash out to, give to Guido or go to Vegas or whatever. Right. So
that's the anomaly where I want to say we're hacking or manipulating here, correct?
Right. Yep.
Okay. So now I just want to do a quick review just because, it helped me understand this. So 4 elements of a deal. We went through this when we went through creative deals. You have a note, which is a loan, a deed of trust saying, hey, the bank has a right to this property. A title is the piece of paper that says who owns the property, not who owns the loan. And then you have the house. Everybody I know is tracking on that. The house, the title is the piece of paper saying you own the house. The deed of trust is saying, hey, the lender has a lien on this property. And then the note is the terms of said lien. Now, Judge Judy, slow Berkey styles, is we had high net worth individuals inside cash flow tactics taking their own cash, then owning the house, and then being the name on title. And as we just discussed, banks did not like that, and they would not refi it out quickly. Correct, Peter?
Correct. Yeah. It used to be that it was 6 months. Most of you know that, a little while back, maybe close to a year ago now, they changed that to 12 months. So if you want to pull cash out of your Berkey, you have to wait 12 months from the time you purchase the property. And it's a 12-month chain of title. So, if you were to go and disrupt chain of title by putting it into an LLC, you bought it in your name, and then you kept it in your name for 3 or 4 or 5 months, and then you put it into an LLC. Well, that change of title changes or starts the clock again on that 12 months. So some people were running into having to wait 15, 18 months before they could do a cash out refinance to pull their cash back out to go rinse and repeat.
And now you being a valued community member inside Cash Flow Tactics, an enterprising lender and an investor yourself, was said there's got to be a better way, right?
Correct. Yeah. It's stepping into the matrix, right? I live in this world. I've helped most of you on this call right now. I've done thousands of loans, and I've stepped into the matrix, and everything's slowing down for me, and I'm seeing it. So, here's what's happened. I did my first Berkey with Jimmy, and I did it the standard way. Back then it was 6 months that I had to wait. So Jimmy took, his 2 months to rehab the property, another 30 days to market it, get somebody in it. And then I had to wait another 3 months to be able to cash out, pull the cash out. And then I had this epiphany. I literally was laying in bed just thinking, thinking about, again, seeing the matrix, living in the matrix. And all of a sudden I realized that basically other people's money, this idea that if there is a lien on the property, it's a rate and term refinance. I do not have to wait the 6 months, or now I don't have to wait the year. And the thought came to me, what makes a bank a bank? FDIC insured for Wells and Chase and some of the, but most of the lenders we work with are not FDIC insured. What makes them a lender? Well, mostly it's just access to capital. And there's lots of people that have access to capital. We've been teaching for years that go get money from rich uncle or grandma and grandpa or mom and dad. They can be the bank. The bank of mom and dad can give you the money, or go get hard money, go get private money. And, there's lots of hard money, private money lenders out there. I can introduce you to some. Jimmy knows some. We can get you hard money, private money. Well, what makes a hard money, private money lender a hard money? It's just access to capital. That's it. And so that's where we had this epiphany, Jimmy, that there's a better way. If I can go get private money or hard money from somebody I love, instead of putting my own cash into the deal, I can accelerate how quickly I could do these Berkeys.
And so, that is absolutely genius. And I'm glad the Good Idea Fairy visited you in bed that day. So now, but at the same time now, if I went to Uncle Guido or a hard money loan, regardless of how hot that loan is, whether it's like a Renovo loan at like 9-1 or it's like 15-5, right? The bank looked at that as less risk because it had a deed of trust and a note, correct?
Yep. Correct.
Okay.
And really the risk is not that you got the loan from Guido, it's that we're getting you out of the loan from Guido. That's the less risk versus giving you cash. So that's exactly right. Oh, Guido lent you money. You're a dummy and went and got money from Guido at, 20% and, whatever it might be. Let's get you out of that. Let's fix that. Let's go pay Guido off and we'll carry the note on that.
So essentially your hack is make everything look like a dangerous hard money loan.
Yeah, that's one way of saying it. Yes, Jimmy, that's right.
Because so Ryan Garner, when he would take money from his HELOC, I'm assuming, and I know you guys discovered it with him, I'm assuming he made the HELOC just look like cash.
Yeah, so that's right. HELOCs act as cash. So when we say you're paying cash, cash could be money you have in checking savings, but it could also be a HELOC. It could also be, a parent's money. It could be family member, other family members' money. You can go pay cash for a deal. Even hard money and private money can be viewed as cash, and this, Jimmy, you go make an offer. I'm getting a hard money loan. It doesn't matter the terms. Ultimately, the hard money lender is going to give me the cash and I'm going to go give it to Uncle Jimmy to buy a property. It's a cash purchase versus if I want to buy a property from Jimmy and I'm getting money from the bank, well, I've got a 30-day period of time that I got to go get qualified, appraised, et cetera, versus hard money. So the idea though here is that deed of trust. That is the crux here. The note and the deed of trust is the crux here of this conversation. So what we're doing, so what Linda and I did, my wife and I, what we did is instead of me using my cash like I did on my first deal with Uncle Jimmy, I went and put my own cash in there, waited 6 months, and then started the refinance process. I actually started it about 5 months in, and at just over the 6-month mark, I was able to pull that cash out and replenish my reserves. Now I have to wait 12 months. And I said, there's got to be a better way. And so the second property that we did, we converted I became the hard money lender. So I had the money in my account, in my vault, in my checking, in my savings, in my business, in my HELOC, wherever it was, I had the money. And my wife wanted to buy a property from Uncle Jimmy, and she wanted to buy a Berkey. And so what we did is I lent the money to my wife. We executed a promissory note. That's that first step right there. We execute. Yep.
Sorry.
Yep. No, that's great. We executed a promissory note right there. And then what I did as the lender to my wife, I then went and filed a deed of trust with the title company when she bought the property. It can be after she bought the property. We can always get a loan after the fact, but I did it when we bought the property. So I filed a deed of trust. Basically, it's a claim against the property. I have claim to the first cash that comes out of that transaction, that property, if she ever sold it or refinanced it. I have the first claim as the bank, and then she gets whatever's left over. And so I filed a deed of trust on that property. We call it a lien, and I was in the first lien position. That's important. I was in the first lien position, and then she takes title. She owns the property, but there's a claim on that property that they have to pay me back when we refinance. So this now converts it from her paying cash to her getting financing. Now, when we go and refinance the home, Linda doesn't get cash in her pocket. Peter, the bank of Peter, gets cash in his pocket, and it converts it from a cash out refinance to now a rate and term refinance. Rate and term refinance gets better interest rates. I don't have to wait the 12 months. I get lower fees. Ultimately, we get our money back much quicker, as we just outlined, approximately 100 days or so. I have my money back versus waiting 365 days to get my money back.
So the big meathead overall picture for me, I'm going to translate what you just said. It's like you have to get a note and deed of trust. And you guys will be like, well, where do I get a note and deed of trust? You guys already have that and access from the private money course. You guys already have that. So it's just another template. Now, I know there's going to be questions around the LLCs and whatnot. So, Peter, why don't we let the group ask some questions? And then because I know there's restrictions around the LLC. If that doesn't get hammered out as a question, then we'll answer that as well. So, fire away, gang.
Peter, I'm asking for those of us that don't have a spouse, is there a scenario where this would work if we were like, I could, I don't know, do the same transaction with my brother? Or
yes, yeah, Armand. In fact, the Axe brothers are doing that right now. Again, Chris lending to John, through his LLC. So 100%. That's kind of, if I'm going to hammer home just an idea, it's that private money, hard money can come from anybody, anywhere. You guys, there's lots of access to capital out there. It's just a matter of finding it. And so it doesn't have to be a spouse. It could be a brother, sister, mom and dad, uncle, aunt, cousin, neighbor. It can be anybody. Correct.
But Armand, a year ago, I would have been just like, hey, get some money from your family and then tell the banker it's cash. But now we're saying, hey, hopefully your brother has an LLC, and we want to put your brother's LLC as the lender and list them as the person on the deed of trust. Right, Peter?
Correct. Yep, that's right.
Perfect.
So a very important hack.
So always need to be LLC of the lender, right?
You think about a bank, Lana, any bank is going to be incorporated or be an LLC. So it could be an incorporation, it could be an LLC. LLCs are so much simpler to manage, especially we like the single member LLC. So Jimmy alluded to this just a second ago, and so maybe I'll get into it right now that, if I as the bank am lending to my wife, we don't want to use an LLC that she also has ownership in. It needs to be at least that I'm the only owner, or me and maybe somebody else is a partner, but Linda does not have any ownership in it. Because if she has ownership in it, she's now lending money to herself. Lenders aren't going to like that. So we want it to be an LLC that is ideally a single member LLC is the best, because then I don't have to necessarily file separate tax returns and do all of those things. We've had people use their Wyoming LLC holding company. We've had people set up a new LLC immediately upon doing this. I mean, we've run the gamut now.
And one thing to consider, guys, if you're going to be doing this, we just finished up the last DTOM training on how to take the active portions of managing your game plan and move them over even as a W-2 to show enough active activity. This would be something that you could run out of that active S corp, as long as you're not running a business, right? If you're just doing what I taught on the last DTOM training, if you don't know what I'm talking about, go watch the last DTOM training. But that's an entity that you could also run it out of, because now you've got more active activities to justify moving your DTOM over.
I love it. And Brad, the question always becomes, is there a tax liability for doing this. Now I'm making, that LLC is receiving money, but in order to receive that money, they had to pay a bunch of money out, so I had to pay $100,000 out before I ever got that $100,000 back. Maybe you're collecting some interest,
But that's actually, again, for you guys in the mostly passive world, that's actually a good thing to move a little bit of income over, because then we can stack all of our expenses against it and take our losses. So there's benefit to do that. Fits perfectly into what I taught on the DTOM thing. So keep going, Peter. This is amazing. Just consider looping that part of the training in.
Yeah, and there's and so there might be some interest payment in the case of like Ryan Gardner. We had a nice appraisal come back on one of his, so he charged himself some prepayment penalties. He charged himself, some fees. But I should say his wife charged him prepayment penalties and fees. And so his LLC did generate some income above and beyond what his LLC lent out. But ultimately, again, that's okay. One, we can write off most of those expenses. Two, if we show a little bit of income there, the tax liability on that's going to be negligible, if any. So
Peter, you're a greedy bastard with the fees and everything.
I know you can. And so
it costs a lot to feed dolphins in Hawaii.
Yeah. So here's the coolest part about this. I think it's the coolest part about this is that we now, instead of doing deferred financing was a tool that we would use where I would pay cash today, and then I would start the refund, or I'd start the purchase process tomorrow getting financing. So I give Jimmy my money today, and then tomorrow, and so now I own the property, and now I'm going to do deferred purchase or a delayed purchase. And I'm going to start that process tomorrow. I'm going to go take me 30 days to get the financing in place. And then it's as if I purchased the property with financing, but Jimmy got his money 30 days earlier. The problem with that is that now the lenders treat that as a cash out refinance. So you don't know that. They call it deferred purchase, but ultimately it's priced on a cash out refinance. Also, you're limited to what you purchased the property from Jimmy for. So you might have bought a property from Jimmy at 150, but it might be worth 160. And you don't get a benefit from that other $10,000 in equity when you do the deferred financing, when you do the delayed purchase. So what the cool thing about this is that I can start the process again day one, as soon as an occupancy certificate's issued, or even just before that, knowing that I'm going to need an occupancy certificate to get an appraisal. I can start the process right away, and I get to use the appraised value of the property. So I get to do 75% of that 160 value versus 75% of the 150. Now, here's what's really cool. When you have, there's 2 or 3 ways this can go. Comes in right at 160. Jimmy's team, in my experience, guys, Jimmy's team is almost always on the money when it comes to the ARV, the after repair value.
Oh, and Peter, I figured out how to level up our game on that.
Okay.
So I am now sending an appraiser to give as is values and what he believes the house will be worth after rehab. I wanted to suck that last, because like I'm good, but I'm not great at this, and it's not my profession. And so I wanted to suck the last piece of risk out of this and give you guys now that doesn't mean the appraisal will come back exactly,
right? But
it's sucking a little more risk out.
Out of the 5 I've done with Jimmy, he was spot on 4 of them. And the one came in a little lower than we thought, but it ultimately worked out. So really there's 3 scenarios.
And I know for a fact that appraiser's wife is really mean. And she had a bad day that morning, and that's what happened to that house, Peter.
Right. So the first scenario is it comes back what we think it is. We're going to lien the property for 75% of what we think the ARV is. And so, the first scenario is it comes back spot on, perfect, and we're good to go, no problem. But the more likely scenario is one of the other 2. It comes back better than what we thought the ARV is. Instead of coming back at 160,000, comes back at 170. Well, that's cash money. That's awesome. So, but what about my lien? My lien is for 75% of the 160. How do I take advantage? Well, that's what we did with Ryan. And that's what we can do with anybody. And that is that you start charging fees, a prepayment penalty, you charge interest, you charge doc prep fees. I mean, title companies, it's death by 1,000 cuts with some of these title companies on their fees. Well, we can do the same thing, as lenders. Let's charge attorney fees and charge hassle fees and charge, whatever it is. to get it up to 75% of the appraised value, that 170. Or
So Peter, do you have that note with all the fees templated anywhere that we could give the community?
I don't, but we can draw one up. I mean, we can use your note and just add a couple of those contingencies.
Yeah, it should be a copy and paste of the penalties.
Yeah, for sure.
And
So-
you're adding them at the end?
Yep, absolutely. So what's going to happen here, Lana, if you think about a normal refinance, what happens is as we move the process of refinancing you towards the end of the process, we, the lenders, are going to reach out to your previous or your current lender and ask for a payoff. And that payoff is going to be generated by that lender stating that Lana owes X number of dollars, plus we have some of these fees that Lana has to pay if she's going to pay us off. If she's going to pay us off, she has to pay us $100 for doc prep payoff fee. She has to pay us $100 for attorney fees. She has to pay us a prepayment penalty of 1%. She has to pay us whatever it might be, plus the principal balance, plus the days of interest that are going to be accrued for the month that you have those final days that you have the loan with that lender. And so we are in control of the payoff when it comes to this. So we can increase that payoff to 75% of whatever the appraised value is, just simply by adding some of those fees. Candidly, it probably should be in the note, but we haven't found a difference so far in having it in the note, not having it in the note, those prepayment penalties. The lenders just are, these underwriters.
The lender's never going to ask for the note.
No,
they just
they're
ask for the
checking
payoff.
boxes. They're just checking boxes. There's a note and a deed of trust. Checkbox, checkbox. They don't read.
But you just put it in the payoff.
Yeah, we're just putting in the payoff. They don't read the note.
Here's what I'm going to do, guys. I'm going to go to the payoff that you guys have access to. I'm going to talk to Peter, and we're just going to put in line items for fees.
Awesome.
Can I ask you one more thing? So does it make sense when you are actually drafting the note to say, okay, this is like, let's say the house is 125 plus the rehab is another 30. So this is 155 plus you're saying, okay, I will need another $10,000-$15,000 at the end. So adding that and then saying, this is the note. And then if it comes back and it appraises, so the 75% is going to be lower than that, you will just pay the difference. Is that a different way to do it?
Yeah, yes. So that's kind of the third scenario. So the first scenario is it comes in spot on. Second is it comes in above appraised value. We add some fees and costs and other things to take advantage of the full 75% out of the appraised value. The third scenario is it comes in low. We thought it was going to come in at 160. It came in at 155. Well, this happens all the time. If you think about it in terms of lending, it happens all the time. It's called a short sale. A short sale is I paid back the loan, but I paid actually back less than what the principal balance was. Now, what makes a short sale bad is that then the lender is going to go report that to the credit bureaus as a derogatory action. They got paid back less than what we had agreed to. But the reality is that this hard money lender isn't going to report it to the credit bureaus, and you're probably related to them. So
I don't know why. I don't know, Peter. Your wife might tattle on you.
She might.
I know she carries a grudge, so she might.
She's tough. She actually threatened me on that fifth deal we did with Jimmy. But no, so they're not going to go report it, and so we're really in essence short selling it. So we said 75% of the 160 and it came in at 155. Well, we just have to adjust to 75% of the 155. We just forgive the difference, that extra 75% of the $5,000, that, whatever that is, that $3,700. We forgive that $3,700 in our payoff. And so we just write the payoff as 75% of the 155. So Lana, you don't have to come in with the difference. You could, but you don't have to, because you're in control of the payoff. And so you write the payoff to be 75% of whatever the appraised value is.
And so now let's say this happened with a private money lender. Most private money lenders don't want their money back anyway. So then I would at least say, hey, let's say they lent you 150. I'd say, hey, Mr. Private money lender, I can get you 140 back. Can I write a secondary note for 110 and pay you back over time? And I guarantee you most of them will go for that.
Yeah, or hey, can I roll that other 10,000 into this next deal that I'm going to do because I believe the ARV is higher on that, and so now I owe you the 10 plus, whatever I'm going to borrow from you on the next deal. And so 100%, they're going to work with you on this. Something that we've learned that we like, a kind of another hack, a hack within this hack, is that when you're writing those promissory notes, Jimmy knows this, hard money lenders have, you are the bank. You can set whatever terms you want as far as payback is concerned. And I had it initially set up to where I lent the money to my wife and she had to pay me on a monthly basis, the interest payments. And it took us 90 days or so to get through that first transaction. So we had her making a couple interest payments to me. Again, it's money from her to me, it's staying in the family, but we showed that. We showed that on the first one. What we changed and what we did and what we recommend you do is, the reality is that hard money lenders can say, hey, don't pay me back until you refinance this property. Don't pay me back until you've sold the property. At that point, you can pay me back all the interest that's accrued. And so the reality is you can set these promissory notes up to be whatever terms you want. If you want it to be a 2% interest rate or a 20% interest rate, you can do that. I recommend market rates, do it as 6, 7, 8, 9%. You can also say, hey, I want interest payments on a monthly basis. Or you can say, hey, don't pay me back any interest until you go and refinance the loan. We like that because then we're not having to show that Linda made payments for the 2 or 3 months that she had that loan out. We're not having to demonstrate that she was making payments on that. Really, what we did is she just simply, at the end of the loan, I wrote up a payoff that she owed me, whatever it was, $100,000 plus $10,000 of interest. So she owed me $110,000. And
Peter, a question for you. About 10 months ago, is there any hack for we're starting this business? Obviously, the income is not there. What compared to what we had with the W-2, is it just a waiting game, or is there hacks around that?
No, yeah, there's hacks around that. So a little off topic. I'll answer it quickly, and then you and I just need to jump on a call here sometime, Nick. Okay. The hack is what's called a DSCR loan, a debt service coverage ratio loan. Basically, they don't look at your employment income, your employment history. They just look at, does the debt service, that means the mortgage, is it covered by the rents? So as long as we're buying the properties that Jimmy and Brad recommend we buy, the rents should more than offset the mortgage payment. And as a result, you should qualify for a DSCR loan, even though you are unemployed.
And you can do that. Fun employed, baby. Yeah. So you can do that. You can do that for Jimmy's properties.
Yep. For sure.
I got to jump, but I'll message you. If you've got access to the private money, I'm just getting the business going, and I don't want to put the private money into the business because it's going to take longer to get it out to the my parents, the lenders. But we could do it for the BRRRRs easily. So okay.
Yeah. So reach out to me, Nick. I'll probably introduce you to Emily Hall. She's my team member, and she's handling most of these investment loans right now for me. So there she is, Emily's as well. We'll get you connected with Emily. I know you and I have, so you probably don't have Emily's contact. Just reach out to me. I'll get you connected with Emily.
Okay, perfect.
So can I ask a clarification question?
Yeah, you bet.
So if I'm using a private money loan or a hard money from one of the Renovos or Limas or whatever, then to be able to put the lien on the property, then if I'm getting money from either one of those sources, then I can't really be buying the property. I need to be having somebody else buy the property so that I can then put the lien on it. Yeah, correct. So there's two parties involved. There's the lender and there's the buyer. So we got to just make sure that we have that clear distinction. So if you're going to go get the if somebody else, Leah, is going to get the financing after, after you've bought the property, that's who you want buying the property. So Leah, that's your husband. If your husband's the one that you're going to get the I would be buying in this case. Let's just talk reality. I would be getting the financing on the property long term.
So then you want to be the buyer and you want to go get a lender, and that could be your husband or it could be somebody else, Leah. And so you want to have a distinct party, individual party that is separate of you lending you the money. It can be your money that they're lending you. I mean, like I say, my wife and I, we don't have separate checking accounts. We don't have separate bank accounts. The only thing we have separate is our vaults, but we need to switch that to, to where we co-own them. But the vaults are, in my case, I had enough in my vault that's where my money came from to lend to Linda. No, but it could be your checking account, joint savings. It could be a HELOC. It could be, money comes from wherever. The reality is that if you think about it, does the new lender look at where the previous lender got their money ever? No, they're not looking into Wells Fargo is not going and looking into Chase's account and saying, does Chase really have this money to lend to Leah? No. They just say, oh, Chase lent money to Leah. We can see that because there's a claim filed on, on title here. There's a deed of trust filed. And so we just need to pay Chase off. And so the same thing happens here. It can be, money that is coming from a joint checking. Your husband's simply saying, hey, I'll lend it to you, Leah, but you need to pay me back at an 8% interest rate, with a 1% prepayment penalty if you pay it back before a year or whatever. I mean, you can create all of the things that you want.
But Peter, on a lazy landlord, I remember, I think we did a refi, right? I mean, because I already have it rented. So I think I closed it cash and then we just, I don't know, within weeks.
Harold, yeah, I believe we did deferred financing on that, Harold. And deferred financing is still a great option. It's just not as great as this new hack that we've discovered. So that's most like, if my memory serves me, I'm almost 100% confident that's what we did, is just the delayed financing on that, where we just went in after the fact and got you back 75% of the cash you paid. This is better.
Yeah.
This is better because we'll get a slightly better interest rate.
Okay.
Better in interest rate, and had that property appraised for quite a bit more than what you bought it for. We could have gone and used the appraised value and gotten you 75% of the appraised value versus 75% of the purchase price.
Peter, if the property appraises significantly more, like 10 or 15,000 more, I don't know if it will happen or not, but like how much money can you actually include in all these fees and prepayments and all this other stuff? What is realistic? Is like 10, 15,000 a realistic addition?
Yeah, so you got to remember, we're borrowing 75% of the increase. So if we have a $10,000 increase, we need to show $7,500 worth of costs to make up that $10,000 increase in cost. Does that make sense? So if it comes in at $10,000 higher than we thought, then we could borrow another $7,500 of our money back out. We could get it back out, pull $7,500 more out. So you could go and create that many fees. The reality is that most of the time on these Berkeys, you're not going to see that drastic a difference. Jimmy's team's got a really good idea on what the ARV is going to be. We're seeing that they come in maybe $2,000 higher, $3,000 higher, and then you're only 75% of that $2,000, which is $1,500. That's easy to come up with. Lana, to be candid, we've not pushed the envelope to see if $7,500 worth of fees would pass mustard. I would say that it might throw up some red flags. There's a threshold out there somewhere that's going to throw up some red flags. We just want to be cautious of that. The reality is we go back to the drawing table and refile a new lien. Guys, when we file a lien, it sounds like this really fancy thing. All we're doing is getting a new loan or giving a new loan to ourselves. So if let's kind of play Lana's idea out here just a little bit. Let's say I bought a property from Jimmy Berkey and we thought the ARV was going to be $150,000. I'm going to go lien that property for 75% of that $150,000. So, that's going to be what, 40, it's going to be a little over $100,000 that I'm going to lien that property. And let's say it comes in at 170. Jimmy and Christy just missed the mark, right? And they got, it's $170,000. And I can get 75% of that $20,000 difference. That's 15 grand that I could go get. Well, I could try to explain away $15,000 worth of fees, prepayment penalties, and other things, but that might throw up a red flag. So what I could do is I could go, my wife could go back to Peter and say, hey, I want to borrow that $20,000 from you. I have more equity in this property than I thought. I want to go borrow that $20,000, or I want to borrow 75% of that $20,000 of equity that I found in this property. And Peter adjusts his lien on the property as the bank. Peter adjusts his lien on that property. So instead of being a little over $100,000, now I lien the property for closer to $120,000. So I adjust my lien. And then Linda goes back and starts the process again with the lender. If we do it with the same lender, oftentimes the appraisal can be transferred or reused. So ultimately, you can still take advantage of that equity. So It's just a matter of understanding how banks work, and we play the part of the bank. We become the bank.
But Peter, how long would you need to wait if you, for example, if you say, okay, I go back to my mom and dad's bank and I say, oh, I want another $10,000 or $15,000. How long would you need to wait between that initial appraisal and the time when you can actually submit the refinancing again?
Yeah, I can refinance at any point, Lana. There is no time period, waiting period. The only waiting periods that exist are when we're doing things like a cash out refinance. Then you have to wait. But in this case, we could basically, in theory, do it the next day. I could go Bank of Peter for Linda. The Bank of Peter could go adjust his lien on Linda's property, and then tomorrow Linda could start the refinance process. It'll take her 30 days or so to work through that process of getting that new financing in place, but ultimately she could do it in theory the next day.
So as long as there is no title change, right? So as long as there is still the same owner, we are good. No new LLC, nothing like that. Okay, got it.
That's right. All we're doing is Linda's saying, hey, Peter, I want to borrow more money. And I say, gladly. Jimmy just said that earlier, as a hard money lender, I'm thrilled if I can lend money out on a good deal. And I'm more thrilled if they want more of my money on a good deal. And so I'm glad to give them the extra difference if that appraised value comes in high. So it's a matter of just, you can work with Emily and I on this. We're going to take good care of you guys through this process. We understand a lot of these nuances. We'll work through this. If those kind of scenarios happen, we can help you. And the vice versa. If it comes in low, we go back to the drawing board and adjust how much that payoff is going to be. The reality is that we're in control, and that is the coolest part of this thing.
And so, tell me if this makes sense, you guys. You could go down to the county and put a lien on a property for anything at any time, anywhere. That's why I've had mechanics liens. Like a contractor gets mad at me, he goes slaps a lien on the title, then I can't sell the house. But this is genius, Peter. You're saying do that to yourself to maximize out that appraisal value. And then here's another example of this. When I buy a house from the government, and sell on a government loan, Peter, for an FHA conventional mortgage, they won't pay assignment fees, right?
Right.
So wholesaling wise, the DBA of my wholesaling business is I buy STL. The real name of it is STL House Funding. And the reason we did that is to get our assignment fees. We just put a notice of interest on the title that the seller agrees to. And then the conventional lender just looks at STL House Funding and they're like, oh, that's not a wholesaler. That's a bank. And then they pay that on that lien.
Yeah, you've got multiple liens on the property. You've got a first and a second and a third, and the banks are going to go pay off those first and second and third claims on, mechanics liens, contractor liens, the lien from the bank. They're going to go satisfy all of those. And that's a genius way of getting your wholesaling fee.
Do you like that?
Yeah, that's awesome. It's the same principle, what we're talking about. The one thing to be aware of, guys, is that you can't do this. If I have a property that I wanted to say refinance, and instead of pulling cash out, I wanted to call it a rate and term because Peter says I get better rates and lower fees and things, and I have a bunch of equity in it. I'm looking at some of my portfolio right now, and with Jimmy, I've had some of these properties 4 or 5 years, and I've got all sorts of equity in them. They've appreciated a ton. And if I want to go cash those out, I cannot use this same hack to go convert that cash out to a rate and term because I've already got a first lien in place with my existing lender. So this only works in a first lien position. So it only works on a scenario in which we are doing a BRRRR. We're paying cash up front, and then we're coming in, leaning the property first lien position. Anytime you're satisfied, well, not anytime, most of the time when you're satisfying a second lien, they count that as a cash out refinance. And the reason for that is if you think about a HELOC, I can't go open a HELOC on my home, and max my cash out, pull all that cash out of that HELOC, and then go to the bank and say, I want a rate and term refinance to pay off my first mortgage and my HELOC. They know I've put cash in my pocket, so they just say, what, you're trying to game the system here. That's a cash out refinance. So anytime we're satisfying a second lien, I keep saying anytime, most of the time when we're satisfying a second lien, it's considered a cash out refinance, so it doesn't work. So this only works on BRRRRs. or properties that we own free and clear. Maybe you didn't do a BRRRR, but you bought a property and you aggressively paid it down. Now you regret not having financing on it, or you want to pull the cash out. This is the way you would do it.
And it'll work on turnkey assignments, and it'll work on tired landlord deals as well.
Yeah.
So Peter,
Go ahead, Brian.
Yeah, so I'm in the.
Sorry, go ahead, Captain.
Sorry, thank you. Appreciate that very much. Yeah, so we're in the beginning stages of a BRRRR with Jimmy. So I'm just gonna see if I took some notes to see if this is kind of what if it makes sense in my brain. But so we raised private money, 170 grand from a private money lender. We signed a deed of trust and a note. The title is going to go into my name. Jimmy's team is working on the property at the moment. Once we get our occupancy certification, the lender, my original lender, is then going to place a lien on the property. We're going to come to you and we're going to get it, or we're going to get it appraised. We're going to come to you and we're going to be able to pull out 75% of it. And then, so now we have the loan from you guys, and then I could take that 75%, roll it into another property by signing another deed and a note. Is that right?
Yeah, 99% right, Brian. One little nuance there that I'll correct you on. I would file the lien, do the note and the lien right when you're buying the property from Jimmy, or now, if you've already bought the property from Jimmy and he's working on it, go file that lien now. There's no need to wait until the occupancy certificate. And, the occupancy is when you and I are going to start the refinance process. But you can file the lien now. And I do that to 75% of the ARV. Whatever Uncle Jimmy says the property's going to value at, once it's done, go do a lien for about 75% of that.
And how does that template look different than the original deed of trust? Because I have the original deed of trust was notarized. Is there like a format we should follow on how that actually works? And the second question is, does my private money lender, who's a friend, now need to go open an LLC real quick before we do this?
Yeah, that's a great question. No, he doesn't have to open an LLC, but I would highly recommend it. Brad looks like Brad popped off here, but there's a lot of benefits to him for having that LLC. So I would recommend the LLC, but he doesn't have to. Private money lender can be an individual as well. We can file a lien in their name. So that's a good question. And so we could do the same with, Peter could have lent money to Linda, but it throws up red flags when it's Peter Skaggs is leaning the property personally for Linda Skaggs, and so it raises red flags. And I guarantee we got through one, and I forget whose it was. But it was like John Doe LLC lent money to Jane Doe, and we were able to work it out and get it solved. But ultimately, it created a bunch of red flags that the lender, we had to jump through extra hoops. So my recommendation is that John Doe LLC actually not be named John Doe LLC. It should be named ABC LLC that lends money to Jane Doe. If that makes sense. It's best if the LLCs just aren't tied to the buyer through last names or something like that, just simply for the fact that it gets the underwriter scratching their head, and now we open a bit of a can of worms. We've gotten through it, guys, so it's not like it's wrong or bad. It's just simply I'm trying to help you reduce headache on that. But Brian, back to your question there, if he's already filed a deed of trust, then you're in good shape. If you've not filed a deed of trust, that's what we need to do. What I would recommend you do is file a deed of trust, and I would do it at 75% of the appraised value, or the ARV for now. So,
because I just,
Brian, did that note and deed of trust get recorded at title?
It did already, and I just sent it in, but it didn't have any information about ARVs, or it was just basically like, if I default, then the property goes to them. That's kind of, I followed the exact template. So just keep
the note has what you lent onto them, you'll be fine.
Yeah, and Brian, notes are not typically recorded with the county. Note is just kind of the promise between you and them, and so you can adjust that note or change that note or amend that note throughout the process. Because Jimmy knows this. A lot of us who have used private money know this, that sometimes the deals have to change. There's new information, the market changes, whatever it might be. And so you can amend these notes. So you can just go amend the note, because that's not what's filed with the county in most cases. What's filed with the county is the deed of trust. And the deed of trust simply says that there is somebody on this property that has a claim against the property that needs to be paid off. And then what will happen here, Brian, is that when you guys go to refinance, we'll order an appraisal. We'll say, hey, here's the appraised value, and we want to make sure that the payoff is 75%.
Yeah, the real magic happens when you send the payoff.
Correct.
So, and then you draft your own payoff, and then you get the private lender to sign off on it. So any of these shenanigans y'all want to play, you'll do it with the payoff statement.
Okay, so I'm set up correctly at this point of where I'm at in my
It
stage.
sounds like it. Yeah, it sounds like, Brian, without being able to see what you've done, just based on the conversation, yes, it sounds like it.
So I'm kind of confused what Brian, that sounds exactly like what we've been doing. I mean, we're recording a deed of trust with whoever's we're borrowing money with. And I mean,
Right.
I was giving we always say they win or that you get paid or you get a house.
You get or you get.
So, right, you get or you get. And so I'm if you said we don't need an LLC to do this, I'm struggling with how this is any different than how we've been doing it, where we need to wait 6 months.
Yeah.
What's the difference? What's changed?
The big difference is when I go borrow money from a hard money lender, usually they're lending me 75% of the purchase price, or maybe it's 75% of the ARV. And then when I go and they go file a lien, then we go pay off that lien. That is exactly what we're suggesting here, Jim. The difference, or the reason this is, this was an epiphany, is because you're talking hard money lender, like a legit, real hard money lender. I'm talking about Peter becoming a hard money lender for his wife, Linda. So
right.
It's the exact same thing. And that's what we're trying to show you guys, is that it is the exact same thing as what you've already been doing. And that gets into what Jimmy's going to talk about here, as other people's money. The difference is simply that when I was buying BRRRR keys from Jimmy, I wasn't going and getting hard money, private money. I was using my own money.
So let's say it's not a spouse that we that we're close with and can work closely with. Let's say it's sweet old granny or somebody that that just has no clue what's going on. And and to me, it's like what does the pitch look like? What changes? I'm not hearing anything that's different.
So let me break it down. So the refi, the no house you did, where did the cash come from?
It's kind of a bad example because I did put a bunch of my cash in. So it was part private money loan and part mine. So it's
but this is actually a great example.
It is.
Yeah, but that's not really repeatable because I was actually.
Well, just hear me out here. This is a great example. So what was the paperwork? Did you do any note and deed of trust?
I gave a note and deed of trust for the portion that I borrowed from a private lender.
Okay. So all we're saying is you also should have done a note and deed of trust.
Yeah.
For yourself. And so what people have done, hold on 1 second, Peter. So what people have done in the past is they've taken cash, because the only people that force a note and deed of trust is hard money lenders. But now when people were taking their own cash or private money, they were making it look like cash. So this is where you always got to lien the property. So just like on Hitch, don't dance like that. Don't do these things. Always lien the property. Always have a note and deed of trust that is registered at title, so you can do these type of loans that Peter's talking about. So if you are using hard money loans, this is not news. If you are using your own cash or somebody else's cash and not liening the property, this is news.
Yeah. And Jim, just food for thought after the fact here, being backseat driver, but what you could have done, depending on your relationship with that hard money lender, is go create an LLC that, you guys co-own. Maybe your holding company owns a portion of that LLC. They own a portion of that LLC. And then you go and lien the property for 75% of the ARV, getting you paid back as well as them paid back. And you can create these, banks, these entities in a way that, you could have gotten some of your cash back in that deal without calling it a cash out refinance.
Yeah. And I consider mine a bad example because what I ended up doing was the cash I was using was actually the cash that I needed to pay my tax bill in April. And this was a way to utilize that to do a deal. And then when I did the refinance and got my cash out, I used it to pay my tax bill. So I don't have that cash anymore. So if I'm going to do any more, I'm going to be borrowing the full, purchase plus repair. Like, I'll be all in for, if I did that exact same deal again, I'd be all in for 150K with an ARV of like 180K, and I would be going to somebody and I'd say, hey, I want to borrow 150,000, and I'd buy it for the 130, and I'd the title company to hold the rest for the repairs and stuff. And so, and is that a situation because that borrowed amount is more than 75%? Eventually I'm going to refinance and I'm going to have to bring cash. I'm going to have to bring my own cash to pay off because I don't get the full. I'll get 135, which is 75% of 180. So I'll need to pay off the 150. I'll need to, come to close with some cash. And so is that not applicable because that loan amount is already well above that 75%?
Yeah,
and can we just treat that as rate and term then and not have to wait?
Yeah, Jim, what you just described is it was the epiphany that I had.
Okay.
I can do it the Jim Bevins way, go out and get real hard money or real private money. But why is that private money lender different than me lending to my wife?
Mm-hmm.
It wasn't. And so the epiphany that I had is that I could just bring that in. And now I could do exactly what Jim's doing, a rate and term refinance, 75% of the ARV. I could do that, but I can do it internally. I can do it much closer to the vest instead of bringing my own cash into the deal and then being limited by all these factors of cash out refinance. I could just become the hard money lender and allow my wife to borrow from me. And so that's all it is just bringing it in closer, to make it work the same way. So what you've just described was the path that I went down. I can do this with a hard money lender. What's to keep me from being that hard money lender? Why couldn't I be that hard money lender for my wife, Linda? And we've proven now over and over and over again that somebody who's related, somebody who's as close as a spouse or a brother or a sister or somebody else can absolutely also be that hard money lender. So it's no different than what you just described.
So Peter, what LLC did you use? I mean, did you use your?
So I have a active holding company and a passive holding company. I used my active holding company. I don't know, Brad might scold me for that, but it may have been better for me to use a different one, but that's what I used. It's Innovative Businesses LLC. I own it 100%, Harold, and that's
right.
And so I own it 100%. Innovative Businesses LLC. Linda doesn't ever get a K1 on that. It doesn't show in her taxes. We file joint taxes too, guys. They know Innovative Businesses. They see it on her tax returns, but ultimately that's who filed the claim.
So you own it 100%. That's that's basically your lending business, right?
It's kind of an active. I do lots of things with that, some marketing, and it's just money's moving through it, and so I like that option. Yeah.
Right. So I'm just thinking. So when you take a HELOC, you dump the HELOC into your active holding.
Yeah, I actually didn't, Harold. Probably to keep it cleanest, that's what should have happened. Is the HELOC comes out and goes into Innovative Businesses LLC, and then Innovative Businesses LLC lends to Linda. What we did, just mostly because we're busy and lazy, we just pulled the money out of my vault and it went right into our personal checking savings. I then wrote the note and Linda used the checking savings to buy the property from Jimmy. And so again, they're not.
So you didn't paper trail it. You're saying you didn't paper trail it from your LLC at all.
I didn't, and the reason I didn't is because I know that they're not going to paper trail Wells lending to you. Chase isn't going to paper trail Wells lending to you.
They don't look at escrow. I guess that's why I'm getting at. So I'm just mentally, I'm doing the mental gymnastics. They're not escrow's not revealing how the check rate came in.
Nope.
So you're just saying, okay, so then it gets paid back to your LLC. And then in turn, after that, you take it from your LLC and pay directly to your vault.
Yeah, vault or HELOC or whatever.
Or HELOC.
Yeah. And one thing that might have saved me on that, Harold, is the fact that it did take 60, 90 days for us to get the property complete and an occupancy certificate and things. So as a result, Linda had a couple months of clean bank statements. They didn't necessarily see the money coming into our checking savings, that then she used to purchase the property. So they didn't see that. So that would be one reason why you'd maybe want to run it through the LLC or somewhere separate, is if Jimmy already had a renter in there and it was going to go quick, So again, I can help you guys with this if you have individual questions. Hesitate to reach out.
That's a very good idea. That way, if you can run the
mental gymnastics with you. Yeah. I'm not as limber as you are, Harold, but
well, no, we're both pretty tight. I can't guarantee it. Linda would put us in shame, no doubt.
That's right.